Hello class, today we'll be presenting American Barrick case study. My name is Jay and I will be presenting overview of Barrick and competitive advantage. Then Hunter will be presenting financing program section, followed by Matthew presenting on hedging strategies, and Marcos will finish off with the big picture and conclusion. Alright, let's kick off with an overview of American Barrick. The company was founded in 1983 by Peter Monk. Peter Monk was a successful entrepreneur and a financer, and he had no prior experience in mining industry, but he wanted to try his hand anyways. And he set up his headquarters in Toronto and Ontario, Canada. And Barrick's main products were gold, silver, and copper. And for this case, we'll be strictly talking about gold only. All right, so now we can discuss how mining companies create value. At the beginning, a mining company goes through an exploration phase where they drill and gather samples to determine the gold availability. For one company to gain a significant competitive advantage, they must invest large capital and possess advanced technology that is way ahead of its competitors. Now, Barrick did possess large capital, but didn't possess any advanced technology. Next, we have an acquisition phase. During this phase, a company purchases the land where they will set up mining operation. For one company to have a competitive advantage, again, they need a large capital to outbid competitors and a little bit of luck when it comes to possible gold deposits. Now, Barrick did have large capital and had a little bit of luck with gold reserves in the mines, but nothing significant enough to have a competitive advantage. The third phase is developing, mining, and processing gold. During this phase, speed and efficiency of processing and refining are key factors. Again, Barrick did not possess any competitive advantage in this section. Now, onto the final phase, selling gold. Now, this part is pretty self-explanatory, and the company's goal is to sell at a higher price and more gold than your competitors. And this Barrick had a significant competitive advantage than its competitors because Barrick was so successful with their hedging program. They became one of the only mining company to be profitable when their competitors were struggling.
Okay, so now let's discuss American Barrick's financing strategies, which were used for raising funds for mainly the activities in the mines after they purchased them. In 1983, it funded its first purchase, actually, of the Renable gold mine in northern Ontario by issuing common shares, but then it needed an additional $18 million for capital expenditures to develop the mine. There were three sources of financing that it used to obtain this capital: gold trusts, bullion loans, and gold index notes. In 1984, American Barrick raised another $17 million through the Barrick-Colleton Gold Trust. This was the first publicly available trust traded in Canada. Through the trust, it paid investors 3% of the mine's output when the gold price was at or below $399 per ounce. Now, when gold rose to $1,000 per ounce, it paid 10% of the mine's output. This was a win-win for the investor, benefiting from the increase in volumes of gold to the trust, as well as the increase in the price of gold. The next vehicle that they used were bullion loans. In 1985, it entered into a bullion loan with the Toronto Dominion Bank to fund the Mercer mine. It did this by putting a collateral of 77,000 ounces of gold up to the bank for $25 million. Now, over the next 4.5 years, it made monthly payments at a 2% interest rate. However, unlike regular bank loans, American Barrick made the payments in ounces of gold. It was also required to make accelerated deliveries of 50% of the cash flow from the mine. American Barrick then made several other bullion loans over the years for funding of other mines, such as the Gold Strike mine in particular. Now, the last financing activity we'll cover that they used were the gold indexed Eurobonds. In 1987, when gold was $400 per ounce, it offered $50 million in 2% notes to European investors. Now, these were mainly European fund managers, and they bought these notes for about $1,300 per note and received an annual payment of about $26 in interest. These investors were also entitled to a redemption of the notes anytime between a given period. If they did redeem their notes at the first opportunity they had, they would receive a certain amount in cash or gold bullion. Now, if they waited to redeem, amount they would receive would actually be increased over time. Now, unlike bullion loans, these gold index Eurobonds did not require to put up collateral. And that's an interesting part. And that made these investments much more attractive to the firm.
Okay, moving on to American Barrick's hedging strategies. Their hedging program really evolved over time. They started with the use of forward contracts, they moved on to the use of option contracts, and then eventually, as they got bigger, they moved on to spot deferred contracts. Starting with the forward contracts, American Barrick used the forward contract in order to hedge downside risk. They were seeing initially a decline in the price of gold. They saw their profitability falling, and they needed an instrument to cover them from the downside risk. What they learned, however, in implementing the forward contract is that it also eliminated the upside potential of gold as it increased. So what happened was they actually profited less so because they had sold the gold forward and using the forward contracts. So how that evolved then was into option contracts. What the option contracts did was allowed American Barrick to create a range of gold prices that they would benefit from. So they could set a floor and they could set a ceiling, and using the collar strategy, were able to benefit from some of the upside, but not unlimited upside, and then obviously cover themselves from the downside. The collar strategy combined the purchase of put options and the selling of call options. And what this did was it created, as I mentioned, the floor and ceiling of prices that they could benefit from. So it did cap the upside risk, and options contracts were only available for a duration of 5 years. And American Barrick was also looking for ways to hedge for further out than the 5 years. So then that evolved into American Barrick using spot deferred contracts. So spot deferred contracts are a contract to deliver over the course of several years. It started in tranches of 3 or 4 years, but eventually American Barrick got to the 10-year period that they were looking for the longer hedge. And the spot deferred contract set a price, set an initial price at contract date for 1 year forward, and American Barrick had the option to either sell at the contract rate or to sell in the spot market. What this allowed was for American Barrick to set a floor price and benefit from either selling at the contract rate or selling in the spot market and delaying the contract another year. The spot deferred contract allowed American Barrick to hedge against the downside, set the floor price, and also benefit from unlimited upside. It added a ton of flexibility. And the spot deferred contracts, at least during the period that we're looking at for American Barrick, there's a lot of volatility and a general downward trend in the price of gold. And this played really well into spot deferred contracts because they were always able to have the floor price of the contract, and if there was a big upside to be had in the spot market, they were able to take advantage of that as well. In general, if there was a general trend upward with less volatility, there wouldn't have been a huge benefit of the spot deferred contracts because the contract price and the spot price would be similar, and so they couldn't benefit greatly from those. they spot deferred contracts over the options contracts because it added the additional duration of the 10 years, and it also added the unlimited upside and just general flexibility in the way that they were selling or hedging their gold. So the spot deferred contract became the main component of the hedging program. And just as I said, based on the flexibility, the long duration, and really limited downside, they were able to, they didn't have to pay the premiums of the options contract. They didn't have to give up the upside, some of the upside like the options, or all the upside like the forward contracts. So overall, American Barrick's hedging program was really a significant driver of their success, and it really shows the evolution of American Barrick. And then spot deferred contracts is really the future of the program.
Okay, so now I'm going to finish up the presentation by discussing the big picture and the conclusion. So the first question to ask is, can American Barrick repeat their success? We believe that their success can be repeated, but it's going to have to depend on a couple factors. One being the economy, another being new technology, and the third being their hedging programs. So starting with the economy, during the timeline of this case study, there was a very unstable environment, which helped them with their hedging strategies. Now, on the flip side, if you have a stable environment and not much fluctuations in the price of gold, they probably would not have been as successful as they were. Next being the new technology. There has been a lot of new technological advances since the time of this case study. So in order for them to succeed, I do believe that they're going to have to really be as efficient and effective implementing these new technologies into their gold mining processes. And then lastly is the hedging programs. They need to continue to solidify their expertise in these programs, since these programs that they used in the case have gained much more exposure since then. The next question is luck versus skill. So we believe that American Barrick's good fortune was based off a mixture of luck and skill. Starting with luck, we believe that they were pretty fortunate that they had such an unstable economical environment. Also, the gold mine acquisitions were very fortunate for them because they found a lot more gold than expected on a couple mines, two of them being the Meekly mine and the Gold Strike mine. And then as far as their skill, their risk management program really did prove to was where they excelled, and they were constantly changing course and adapting to the most effective strategy, which helped them in the long run. They moved from forwards to options to spot deferred contracts. Now with the forwards, they minimized their downside risk, but they also minimized their upside potential. So then they moved to options, which minimized that downside risk, but also maximized some of that upside potential. The only problem was that they needed longer than 5-year contracts. So then they moved to spot deferred contracts, which was the best hedging program for the company because of its flexibility. These 10-year contracts enabled them to capitalize on the increases in gold prices with having little downside risk. So in conclusion, American Barrick needs to stay disciplined and remain unfazed by the outside noise. What I mean by this is that when gold prices are high and hedging strategies seem unnecessary, they need to remember that change is the only constant. The market moves in cycles, so a resilient risk management program is key.